There are certain words that are so commonly used we think they have a universal understanding. One of those words is income. Think about it. What is income? Your paycheck? Dividends on your investments? Profits from your business? When does an increase in the value of something you own become income? The answer to that question is important to more than just the parties in the case Moore versus United States, but to just about every American. Can the United States tax as income the value of something you have not sold yet? We'll discuss that next on the Constitution Study.
Love your neighbors and have a few good friends. Every day we're everyday Americans. Oh, every day we're everyday Americans.
Hello there, everyday Americans. Paul Engel here with the Constitution Study, where we read and study the Constitution, teach a rising generation to be free. I'm glad you could join me today as we're going to talk about income and the income tax, which generally people I know hate. There's a lot more to talk about here, and there's a lot of information you can gather from the website, constitutionstudy.com. I urge you to check it out, but I'm going to talk a bit more about that at the end of the episode. For now, let's take a look at this case, Moore versus United States, and the question of what is income. Before 1913 and the ratification of the 16th Amendment, the United States had no reason to care how much money you made and what you did with it. The framers of the Constitution placed the states between the people and the United States when it came to taxes. From Article 1, Section 2, Clause 3 of the Constitution, we read, "Representatives and direct taxes shall be apportioned among the several states which shall be included within this union according to their respective numbers." While there were multiple attempts to institute an income tax from the mid-18th century to the early 20th century, it wasn't until 1913 and the 16th Amendment that the United States was legally allowed to create one. The Congress shall have the power to lay and collect taxes on incomes from whatever source derived without apportionment among the several states and without regard to any census or enumeration. For the first time in our history, Congress had the power to directly tax the American people. However, this was limited to taxes on income. But what is income? As I said at the opening, income is one of those words most people understand from its common usage. According to Merriam-Webster, income is a gain or recurring benefit usually measured in money that derives from capital or labor. As much as you may curse tax day, complain about the withholdings on your pay stub, or dream about abolishing the IRS, the states ratified the 16th Amendment, allowing Congress to directly collect taxes on your income. While federal politicians and bureaucrats have tried to tax wealth rather than income in the past, they have never succeeded. Well, not yet at least. The argument from the attorney for Mr. Moore started with, "The word income is not an inkblot. Income was understood at the time of the 16th Amendment's adoption to refer to gains coming to the taxpayer like wages, rents, and dividends. Appreciation in the value of a home, a stock investment, or other property is not and never has been taxed as income. The reason is that a gain is not income unless and until it has been realized by the taxpayer. It is undisputed that the petitioners realized nothing from their stock investment. They were not taxed because they had any income, but because in 2017 they happened to own shares in a corporation carrying retained earnings on its books. This is a tax on the ownership of property and therefore must be apportioned. The court should reaffirm that there is no income without realization." These words of Mr. Andrew Grossman, the attorney for Charles Moore, seem to be pretty straightforward. As you would expect, the government of the United States has a different view of income. The MRT is firmly grounded in the 16th Amendment's text and history. The amendment allows Congress to impose taxes on incomes. That phrase had a well-established meaning drawn from numerous pre-ratification income taxes that Congress enacted before this court's decision in Pollock. Several of those taxes were like the MRT in that they taxed shareholders on undistributed corporate earnings, including income taxes in 1864, 65, 67, and 70. And this court upheld Congress's power to impose those taxes in Hubbard. The 16th Amendment's drafters, therefore, would have understood taxes on incomes to include taxes like the MRT. Solicitor General Elizabeth Prelogar, arguing for the United States, claims that the MRT, or Mandatory Repatriation Tax, is grounded in the text and history of the 16th Amendment. She points to several taxes that considered undistributed corporate earnings as income. However, each of the taxes she mentions predated the 16th Amendment. She then claims that the drafters of that amendment would have understood income to include such unrealized gains. She claims that such pass-through taxation has been passed by Congress on several occasions, and that the courts have limited the case the plaintiffs are relying on, McCumber, to specific dividends. A stock dividend, evincing merely a transfer of an accumulated surplus to the capital account of the corporation, takes nothing from the property of the corporation and adds nothing to that of the shareholder. A tax on such dividends is a tax on capital increase and not on income, and to be valid under the Constitution, such taxes must be apportioned according to the population in the several states. Now, General Prelogar even makes an interesting claim. Finally, the court doesn't actually need to resolve any fundamental question in this case about whether the 16th Amendment requires realization. The MRT taxes income that was actually realized by the foreign corporations, and Congress permissibly attributed the tax on that realized income to U.S. shareholders, just as it has done in any number of pass-through taxes throughout our nation's history. The court could say only that and affirm. It appears General Prelogar doesn't think the court needs to decide the question of realization because the tax being challenged is against income realized by a third party. To understand this, we need to learn a little bit more about corporations. While there are numerous forms of corporations, each with their own specific definitions and limitations, in general, at least according to the Free Legal Dictionary, a corporation is an organization formed with state government approval to act as an artificial person to carry on business or other activities, which can sue or be sued and, unless it is nonprofit, can issue shares of stocks to raise funds with which to start a business or increase its capital. A corporation is a separate entity, an artificial person. The purpose of a corporation is to separate and thereby shield the owners from the liability of the actions of this artificial person. For example, if a corporation makes a defective product, you do not sue the owners of the corporation, but the corporation itself. Similarly, when a corporation makes money, it is not the shareholders who are taxed, but the corporation. At least, that's how it's supposed to work. In response to a question by Justice Thomas about realized gains, General Prelogar said, "I think this is a paradigmatic case of realization, Justice Thomas, insofar as that the thing that's being taxed, the underlying tax base for the MRT, are the earnings that came into the corporation, the foreign corporation's coffers. So the tax base here was a substantial ordinary business income that the foreign corporation generated through its operations in the foreign country, and that has to date been subjected to tax deferral. The income has never been taxed at the corporate or entity level. Instead, what Congress did in the MRT is enact a pass-through tax that attributed the liability on that actual income that was realized to the U.S. shareholders." I think what we're seeing here is the greed of Congress. Remember, the purpose of the mandatory repatriation tax is to tax funds earned overseas back to the United States. In this case, the Moores invested in an Indian startup company known as Kissencraft back in 2006. As I believe is common with many startups, the company's earnings were reinvested in the company. In other words, the Moores did not realize any income. They didn't make any money since the earnings were reinvested into the company. Then in 2018, under the recently passed MRT, the Moores were expected to pay taxes on the reinvested earnings going all the way back to their original investment. However, since the corporation in question is domiciled in India, not the United States, any earnings are taxed under Indian law. Since the income to a foreign corporation for its operations in a foreign country was subject to that country's tax deferrals, no taxes had been collected. Not only did Congress want to tax the Moores for income to a foreign corporation they had not received, they wanted to do so ex post facto, or after the fact, violating Article 1, Section 9, Clause 3 of the Constitution as well, which reads, No bill of attainder or ex post facto law shall be passed. We'll have to wait for the justice's decision on this case, but this is what I've found so far. There are several issues with the mandatory repatriation tax, or MRT. First, the MRT taxes one party for the income of another. The entire purpose of a corporation is to separate the owners from the corporation for tax and legal purposes. If Congress can simply decide to breach that legal divide for whatever purpose they want, then corporations are useless. Second is the apportionment problem. Since the Moores, as far as I know, did not receive any earnings from Kissencraft, they have no income to be taxed. Therefore, they are being taxed on the value of their property. Legally, how is that any different than you being taxed on the increase in the value of your home or stock portfolio? The answer is, it isn't. This is a tax on the value of property, on assets, a wealth tax collected directly from the people, so it must be apportioned to the states under Article 1, Section 2, Clause 3. Lastly, since the legislation that created the MRT wishes to collect taxes on the increase in value of the Moore stock since before the tax went into effect, it is an ex post facto law and thereby a violation of Article 1, Section 9 of the Constitution of the United States. So why should you pay very close attention to this case? Because as a direct tax on something other than income, a wrong opinion from the court could open a deluge of new direct federal taxes on everything from your home, investments, even your childhood baseball card collection. Before you dismiss that last statement as a fear-mongering, remember, both Bernie Sanders and Elizabeth Warren have called for wealth taxes at the federal level. While they claim these taxes would be limited to the very wealthy, remember, the same was said about the income tax back in 1913. How has that worked out for the American people every April 15th? So many people complain about greedy corporations. Well, here's an example. You have the United States. Granted, it's a government, not a publicly traded corporation, but it's still an entity, the largest conglomerate in the world. And it's so greedy that it wants to declare something that's as income that isn't really income just so they can tax it. That's greed, ladies and gentlemen. The same greed that Bernie Sanders and Elizabeth Warren have when they want to tax your wealth so that they can use it for what they want. That is greed. They want something. They want to have all these programs, but they want you to pay for it. That's greed. This is a case we should all pay attention to because, again, if the court gets this wrong, how long before, not just your home, how about before your family farm is taxed? Imagine all those generational farmers now saying, I can't afford it because the farm that I purchased 30 years ago has gone up so much I can't afford the taxes on it. Another way to put the small business owner out of business. It's an important case. And while I'm not sure where the court's going to end up on it, it's something we should pay attention to. And I didn't hear anybody there talk about the ex post facto part of this law. If this law says they can go back prior to its implementation to collect taxes, that is by definition an ex post facto or before the fact law. Didn't hear that. That's a very dangerous precedent. What happens when Congress says, hey, we want to tax you on the income you made 20 years ago? Before you think this is crazy, look at what Congress has done. Sure, the Bernie Sanders and Elizabeth Warrens of the world are saying, oh, we're only going to tax the super rich. Kind of like Joe Biden said, we're only going to raise taxes on those making more than $400,000 a year. It's a campaign promise. It's a lie. The same way in 1913 when they said, the income tax is only going to be a couple of percent. It's only going to be on the very wealthy. And here we are nowadays paying, depending on, anywhere from 15 to 40% of our income to the government. And rather than being limited to the very wealthy, it hits about 2/3 to 3/4 of the American earner. Never trust a government actor when it comes to money or power. Now, I've done other talk about taxes and stuff, and if you want to find out more, please go to the website, constitutionstudy.com. I've made some updates to it for the new year. First of all, if you've signed up for one of the mailing lists, I've got several of them. Many of them have a new look. I've doctored up the monthly mailing, the monthly newsletter. There's more information, more stories, more news in it. I've also considered adding a couple of more mailing lists. For example, if you go to the website, you see the news section, the breaking news section. Would you like a daily digest? Once a day, get an email with all those articles in it. I could set that up. I'm kind of see if there's interest in it. Please let me know. Also, if you're watching this video on YouTube, would you consider Rumble? There's a couple reasons for this. One is I keep getting reports that people are having a hard time finding my content on YouTube. I haven't heard any of that from Rumble. Now listen, YouTube gives a lot of great services and there's a lot of great videos on there. And I've used YouTube for years. But if they're keeping people from finding data, from finding my videos, why would you not go to Rumble? And again, Rumble's a startup company. They're trying to offer a lot more services. So any attention we can give them, well, I think would benefit from them. In fact, I'm hoping that they're going to release their cloud services soon so I can host my website on it. We'll see. Lastly, I'm looking to schedule my first Zoom boot camp. We're going to do, maybe we'll call it a Zoom camp. It's the Patriots Program boot camp that I'm going to do over Zoom. So you can participate live. You can ask questions and be engaged. Keep your eyes open. If you're interested, please let me know. I'm still looking for a little bit of feedback on that. I've got some other ideas that I want to keep bringing about, but like a premium newsletter. Would you like a newsletter that not only shows you the public content, but maybe stuff that's insider only? You know, the type of information, the type of articles and content that's only available to people that are subscribed to the Constitution Study. Would you find that interesting? It would also help support the work that we're doing here. So it's kind of a two birds with one stone. Again, please let me know. Just comment or email me, contact me through the website. Anyway, let me know because I'm using your feedback to help guide me this year as I did in previous years. I want this not to be something that is about me. I want it to be something that's useful to you. So I'm trying to find things that you would find useful. Now, hopefully you found this useful enough. You'll come back next time and join us for the Constitution Study.